When we hear about the Federal Reserve, it's almost always about interest rates, right? But what if I told you their most powerful tool isn't about rates at all? It's this $9 trillion behemoth that works behind the scenes, and what the Fed decides to do with it, well, that could have a bigger impact on your wallet than any rate hike.
So, what is this tool? It's the Fed's balance sheet. Honestly, the easiest way to think about it is as the central bank's own gigantic investment portfolio. And right now, what to do with its, nearly $9 trillion in assets is one of the biggest, hottest debates in the entire world of economics. And believe me, this isn't just some stuffy academic debate. The answer to this $9 trillion question is going to send ripples through the markets. It's going to directly impact the cost of, well, everything, from your mortgage to a car loan.
And right at the center of this whole discussion is former Fed Governor Kevin Warsh. He's basically sounding the alarm, arguing that the Fed's balance sheet has just gotten dangerously big and it's time to shrink it down. To really get why he's so concerned, you have to appreciate just how massive we're talking.
Okay, look at that number. At its peak in 2022, the Fed's balance sheet ballooned to almost $9 trillion. That's a 9 with 12 zeros after it. It's a sum of money that's almost impossible to wrap your head around. And its growth has been, well, nothing short of explosive.
So let's put this on a timeline. Before the 2008 financial crisis, the balance sheet was less than $1 trillion. Then, in response, the Fed fired up something called quantitative easing, or QE. And by 2014, it had swelled to $4.5 trillion. Then the pandemic hit, and the response to that doubled it again, all the way to that $9 trillion peak. This was an emergency measure for crisis times.
Okay, we know it's huge, but what does this giant ledger actually do? I mean, beyond being an emergency fund, the balance sheet has a few really critical, day-to-day jobs that keep our whole financial system humming along. Let's take a look inside the Fed's other toolbox.
At its heart, the balance sheet's job really boils down to three core things. First, it manages liquidity, which is just a fancy way of saying it makes sure banks have enough cash on hand to operate smoothly. Second, it helps control interest rates, keeping them in that target range the Fed sets. And third, as we've seen, it is the ultimate backstop for the economy when things get really stressful.
So what's actually on this thing? Well, on the asset side, you've got what the Fed owns. That's mostly government debt, Treasury securities and mortgage-backed securities that it bought up to pump money into the economy. On the liability side, that's what the Fed owes. And that's mainly all the physical cash, dollar bills, in circulation, plus the digital reserves that commercial banks have to park at the Fed.
And this all brings us right back to Kevin Warsh's argument. He and a lot of others are saying that, yeah, a huge balance sheet was necessary for emergencies, but keeping it this big in normal times might actually be doing more harm than good. They think it's time to shrink it.
And here's the core of their concern. When the Fed is the single biggest buyer in the bond market, it's not really a free market anymore, is it? Its massive buying power can totally warp prices. It can push interest rates to artificially low levels, and it just crowds out regular private investors. So the folks who want to shrink the balance sheet say this creates dangerous distortions in the market that just aren't sustainable.
Now, the process of shrinking the balance sheet has a name, quantitative tightening, or QT, and it is the exact opposite of QE. During QE, the Fed is buying bonds, adding money to the system, and pushing long-term rates down. During QT, the Fed shrinks its holdings. Usually it just lets old bonds expire without buying new ones. This pulls money out of the system and, you guessed it, tends to push long-term rates up.
Okay, so what happens when the Fed flips that switch from QE to QT? Well, it sends a major ripple effect across the entire bond market. And probably the most important one is something called steepening the yield curve.
So what on earth does that mean? Let's make it simple. Think about it. Lending someone money for 10 years is way riskier than lending it for just 2 years, right? Well, a steepening yield curve just means you're getting paid a much bigger premium for taking on that long-term risk. The gap between short-term rates and long-term rates gets wider.
And there's a pretty clear chain of events that makes this happen. First, the Fed stops being the biggest buyer of long-term bonds. So with less demand, the price of those bonds starts to fall. And here's the number one rule of the bond market. When prices go down, their yields, which is just their interest rate, go up. And that's exactly what pushes long-term rates higher, making that curve steeper.
All right, I know this all sounds very high level, very theoretical, but it has very real-world consequences. So let's bring this all back home and talk about what this whole environment of uncertainty could mean for you as an investor.
So how do you navigate all this? Well, financial advisors like Edward Jones suggest not putting all your eggs in one basket. For your bond portfolio, this means owning a mix of short-term, intermediate, and long-term bonds. This creates a really nice balance, helping you manage your risk while still generating income, and most importantly, staying flexible.
And here's why that balanced strategy is so effective. If interest rates keep going up, your shorter-term bonds will mature pretty soon, and you can reinvest that cash at the new, higher rates. But if rates suddenly fall, your longer-term bonds have already locked in a good yield for you, and their price could actually go up. See, it's a strategy that's really designed to do reasonably well no matter which way the ripples from the Fed end up flowing.
At the end of the day, whether it's shrinking or growing, the Fed's balance sheet is going to be one of the most powerful forces in the market. So now that you understand how it all works, the big question is your portfolio ready for whatever the Fed decides to do next?